Well, good evening, ladies and gentlemen. I've got a very boring business for you tonight. Very simple, dependable, predictable, not at all exciting. How do I know that? Well, because I've been running it for the past 12 years. The last year since we've been on the market as the chief executive, but before that as the managing director. What sort of business is it? Well, it's a property franchise. That means that we're predominantly a letting agent, residential letting agent, but we also operate as an estate agency business now, and we operate a pure franchise model. Why do I think a pure franchise model is good? Because I think it's a less risky model. Every single office that we have across the UK is cash positive as far as we're concerned. We don't have to worry about the P&L on a monthly basis. That office is making money, that office is losing money. Every single office is paying us royalties. I'm going to talk about the brands in a little while, because we started as Martino & Co. The hint's in the name of our PLC, but more recently we've acquired some other brands, and I'll explain how we've come to acquire them and what those brands might mean for our future. A quick overview. We've been going a little while, established in 1986, and we listed on AIM in December 2014, partly as a partial exit strategy for our founder, Richard Martin. He sold down about half of his family's stake and remains our single largest shareholder. And we decided that we'd been growing through organic means for many years. We've really just had a greenfield strategy of recruiting a franchisee, going into a new location and starting a business there. And our franchisees typically weren't from a property background, which meant we've had a very wide recruitment pool. We've had tennis coaches, vicars, IT consultants, bankers, all reaching a point in the middle of their lives where they want to do something different, and they decided that a property franchise would be the right way to go. But really, we could see that there was more potential to act as a consolidator in the market and to grow at a faster pace, and we decided to come to the city to raise capital to allow us to pursue an acquisition strategy. The group now manages 43,000 properties, and we now have 282 offices. And as I go through the presentation, you'll see that there's been quite a step change in the size of the business from the point where we listed to the point that we're at today. If you're worried about the future of estate agency, and we read stories all the time about what's happening to the London property market, don't worry too much, because 78% of our revenue still comes from lettings. So we are still heavily weighted toward the residential lettings market, and as I'll describe in just a moment, we believe that's a market that has grown and will continue to grow over the next few decades. PLC board. Well, you've got to bear in mind that we were a small privately owned business, so becoming a PLC has been quite a culture shock for us, which I think we're coping with. Richard Martin is the founder of the business. Certainly my mentor, and because he retains a big stake in it, he, if you like, keeps us on the straight and narrow. He's the keeper of the flame, so to speak. I am the corporate letting agent. I had a background with people like Halifax, Yormley, Connells, and I came to Martin & Co to bring my corporate skills to developing a network. David, our Chief Financial Officer, has been in franchising all his life, chartered accountant, but cut his teeth really in the automobile industry for a number of franchise brands, joined us at the time of the IPO, and then Paul joined us as our first non-exec director, and he brings that PLC experience because he sat on the board of LSL Property Services, which trades people like Your Move, Marsh & Parsons and the like. We're currently in the process of selecting another non-exec director to give the board the kind of balance that you might expect as investors. So what's our model? It's a very simple model. We charge an initial fee to join the franchise, and we help the franchisees raise funds from the retail banks. And typically each franchise that we launch the total cost is around £80,000 to launch it. We're a very hands-on franchisor. We help people find premises, find staff, we teach them the system, and we don't let go of them until the business is underway and making progress. We earn our long-term revenue out of royalties, and we charge those royalties at 9% in Martin & Co, and in the business I'm going to describe to you in just a moment, 7.5%. And really that's the beauty of the model, because it being a lettings business, if we can continue to add properties that we manage, then that royalty income will rise year on year in a very predictable fashion. We also carry out financial and brand standard auditing. We like to run a clean, tidy ship. Our customers, our landlord clients are reliant upon us to look after their money. So we've got to make sure that our franchisees are providing good service and that client funds are safely held. And I'm often asked, well, what happens if someone joins your franchise? You teach them the system, they like the system, but at the end of the 5-year franchise term, they want to kind of move on and run their own business. Well, that's not allowed. We would ask them to sell the business to another franchisee who wants to join if they want to exit. And every year we'll handle around 10 resales of our existing franchises. But there's no option to simply turn the signs and leave the group. That option doesn't exist. We make that quite clear to people when they join us. When we do resell a franchise, we do get this new impetus. The new owner of the franchise typically uplifts the revenue by about 30% in the first 12 months trading. So the fact that we continue to recruit new franchisees, sometimes we open in a new location, and sometimes they take an existing office and they rejuvenate that. What's the marketplace that we're operating in? Well, the marketplace has been characterised really in the UK by the resurgence of the private rental sector. It's not widely known, but at the start of the 20th century, around 90% of people actually rented from a private landlord. And then what you saw throughout the 20th century was a decline in that sector, right down to a low point where only 9% of households were privately renting around 1991. Since then, there's been dead cat bounce. The sector's bounced back to about 18% of households now privately renting, and the directors have a belief that that will continue. 1 in 5 households, 20% of the record, will be privately rented by the end of 2016, and within a generation, we think that could be up to a third of the UK population privately renting. How does the market get carved up? Well, the first thing to say is that this is an incredibly fragmented market. There are somewhere in the region of 27,000 letting agents out there, around 16,000 estate agents that you might see on the high street and advertising on the big property portals. And against that backdrop, there are a relatively few number of companies that are dominant in terms of the number of offices. But there's the companies other than us. With 282 offices, it makes us, by that measure, around the 4th biggest estate agent and letting agent in the UK. The other thing that's interesting is that there are a number of property franchise systems operating in our sector, but again, the vast majority of those, 27 operating, are really small scale. Maybe a few offices, maybe a dozen or 2 offices. There is a handful, Wigworths, Hunters, Belvoir and Martin & Co, that have 100 or more franchisees. Of those, all are PLCs apart from Hunters, and Hunters announced today its intention to do an IPO in the next month or 2. So the top property franchise systems in the UK will all become PLCs in the near future. I would describe the situation as one where someone could act as a sector consolidator. If someone has got a good, strong brand, if they've got a franchise system that operates well, and they've got city backing for an acquisition strategy, there is no reason why someone can't actually act as a serious sector consolidator. Let's have a look at what's happened since we listed on the market. Well, by the time we got to the summer and our half-year results, we could see that we had a significant increase in group revenue. It was up 16%. We were quite pleased with that. Our franchise royalties were up 10%. That was good growth again, and organic growth. I hadn't done any real acquisitions by that stage. Operating profits were down marginally. That might be quite a familiar story to businesses that list as PLCs. We face the additional cost of being a PLC, and as a relatively small business, that was quite quite a significant chunk of extra cost. And so trading margin, operating margin was healthy at 40%, that's a darn good margin, but was slightly down on the previous year as a result of those increased costs. However, the transformational position was what was happening to our balance sheet. That had gone from 0.2 million in the previous year to a whacking 5.5 million sitting on the balance sheet by the summer of last year. So we were quite plainly positioned well to carry out and execute an acquisition. We also were quite surprised as new boys in the city to learn that most businesses on AIM don't pay divvies. Quite shocked at that, frankly. Why would you buy shares if you couldn't get a divvy? And because, of course, this was a private business which a founder had set up in order to provide him and his family with an income stream, we couldn't understand that because we're used to paying divvies out every year. And so when we came to the city, we said, yeah, we're going to continue paying divvies. We expect to be paying 50% of our retained profit as divvy every year. And if the profits are going up, then the divvy will be going up as well. So we paid an interim divvy of 1.3p per share. And in our prospectus, we said it's our intention to pay typically around 1/3 at the interim and 2/3 in final. What then happened is we leveraged our PLC status to get a loan facility from Santander, and then we moved to execute a deal that we had been working on since the point where we listed. We started the deal in January, we executed the deal in October, and that was the purchase of the entire property franchise business of Legal & General for £5 million in cash. And what did that mean? Well, it meant that overnight we moved from having one brand, Martino & Co, to owning 5 brands through 3 subsidiaries, Martino & Co UK Limited, which is the franchisor, the master franchisor for Martino & Co, and then the 2 businesses we bought from Experience, Whitegate Estate Agents and Experience Franchising Limited. So we suddenly had 5 franchise brands that we were operating in parallel. It had an immediate impact on our UK footprint. We went up from 194 offices to 282 offices. It continues to be a pure franchise model. That was one of the great attractions of this deal. Legal & General had got into franchising for various reasons and hadn't really developed that strategy any further. And us picking the business up meant that we were buying a pure franchise model, which we understand, and we're plugging it into an existing infrastructure that is already set up to develop franchise businesses. The effect on our lettings portfolio was dramatic, as I'll show you in a second, and we're now managing just shy of 43,000 tenanted properties. And it also meant that within London, we had a remarkable situation where the Ellis & Co offices and our Martino & Co offices, there was only an overlap of 2 offices, and we're now in a position where we've got 46 offices, franchise offices, offering an estate agency and letting service within the M25. We also saw that there was strong estate agency management in Experience, and we ourselves want to develop our estate agency experience, and so we've now got a group managing director who is probably one of the best estate agents operating in the UK, and we're leveraging that experience and expertise. Here's our new footprint. It's a little bit flattering when you look at Scotland, because that's actually, I think, 2 offices cover the whole of that northern stretch. But nevertheless, it's the director's belief that we now have half the UK population within a 30-minute drive time of one of our offices. So that's really quite a step change for us in terms of our coverage. There are pockets, if you know, sort of around Bristol and Somerset, there are pockets now where there are brands from CJ Hole, where locally they are regarded as being the premier brand. If you ask people in Bristol, they say, oh, absolutely, I know CJ Hole, been trading here for years. And if you look at our top 10 franchisees, 6 of them are now not Martino & Co. So it's not that we bought bulk, we think we also bought quality. Some of our best franchisees are now not Martino & Co, they're franchisees of these other brands. And this was the step change in our management portfolio. You can see in 2013 with the light blue line, reasonable, steady progress from around 28,000 to just under about 30,500 managed properties. That continued in 2014, but with that acquisition, kapow, we're suddenly up to close to 43,000 managed properties. So raising money in the city certainly does work if you want to have a buy and build strategy. And then if you look at our royalty income, we've got a bit of a joke, a standing joke in our business, which is another record month. Because if I showed you the last 10 years, every single month of every year is a record compared to the previous year. Every January is a record compared to the previous January. That's what I mean about boring, predictable, safe, dependable. What we've now seen, of course, with our extra royalty income coming in from experience is another step change in royalty income, which we expect obviously to carry on into the new year. If you're worried that we're getting into a estate agency and a estate agency is a cyclical business, well, you're right, estate agency is a cyclical business. And I've been told to my face that a lettings pound is worth more than an estate agency pound by my investors, and so we like the fact that you're a letting agent, we like the predictability of that. But in reality, we're still predominantly a lettings business. Even with our acquisition, you can see that we are dominated by our lettings revenue streams. We also have a shift in our franchisee profile. If you look at 2014, you can see that some of these younger businesses, these younger franchisees more precisely, there's been an uplift in there. That's good, because young franchisees are typically franchisees that are growing at a faster pace. They've got to get a wiggle on because they've got to cover their overhead and they want to push the business forward. But you can also see that we are not a turn 'em and burn 'em type of franchise. You know, we're not one of these franchise operators where they're only interested in the initial training fees. We've got franchisees who've been with us for 5 years or more, so the system must work. It's not an exploitative system and it must work for them, otherwise they wouldn't be staying in the franchise. What's our outlook? Well, we believe that the next 6 months is really all about consolidating the acquisition, because there's no point acquiring fees and then they rock around and cause problems. We've got to consolidate the acquisition. Where we've got duplicate costs, where we've got headquarters for experience and headquarters for marketing, we're going to eliminate those duplicate costs. And we need to leverage the estate agency management experience that we bought to get lettings in experience moving forward a bit faster, and estate agency at marketing colour. We haven't stopped our organic growth. We expect to have another strong year, good strong organic growth, plenty of new franchisees being recruited. But we are still looking at other targets for a buy and build strategy, both at our corporate level. Are there some other franchise brands out there that we could target and purchase? And also at a franchisee level, are there competitors that they could buy and plug into their existing business? So I think the investment case, why should you buy the shares, comes down to this essentially. We're in experienced management. Myself and my colleagues have got over 100 years between us of lettings experience. Our model's been proven to work, otherwise we wouldn't have the profile of franchisees that we have. We believe that in a maiden year, it's always a difficult year, we did what we said we were going to do. We took the city's cash and we went out and we made a very significant acquisition. We've got a cash generative business, we don't buy any stock, we're not exposed to currency fluctuations, and of course we've got strong margin as well. You saw the strength of the margin that we're making. And we believe that in our marketplace there are still plenty of targets to go at and we could consolidate our position even further. I guess ultimately, I think if you're buying into our shares, then what you're buying into is the belief that the private rental sector is going places here in the UK. That's one of the key things that you're buying into. If you think that's true, we're a good stock to buy. However, because of this acquisition, you're also hedging your bets a little bit now, because if the estate agency market is good in the next few years, we have got an increasing exposure to estate agency as well, which is excellent. And of course, let's not forget that we've got a progressive dividend policy. We're used to paying out divvies, we're intending to pay divvy in the future, so if divvy income is important to you, then I said there was a compelling reason to buy the stock too. Thank you very much.
Any questions for anybody?
In terms of the structure, in terms of the divisions that you have, the number of employees, where the headquarters are, etc.
Yeah, of course. We're headquartered in Bournemouth, though Experience has a headquarters in Thiel, just outside of Reading. There are 38 full-time employees in the business, so we're quite lean. Because if you look at how many franchisees and staff we've got, there are around 1,600 franchisees and their staff across the UK. So you've got this huge number of franchisees and their staff, and then this relatively compact headquarters. And of course, that's the efficiency of the franchise model. In terms of divisions, well, we provide there's a franchise recruitment operation, franchise support, because it's really critical that people get intensive support, particularly in the early stages of growing their franchise. Big investment in digital, marketing, brand standards, and of course auditing as well, because you need to check that franchisees are being honest with you and paying you the royalties correctly as well. So that's a snapshot of us, really.
As a result of the acquisition, you have a number of brands. Is your intention to consolidate under your corporate name or run as separate brands?
We like a parallel brand strategy, and the reason that we like that is that it allows us to fish twice in the same pond. Because if we've got a strong marketplace, we can operate the Martino brand in that marketplace, but we can also operate a strong regional brand there as well. So that to the public, they look like two competing businesses, but behind the scenes, all of the royalty income from those businesses is coming into us. It was a little bit of a conundrum for us when we got on to target with Experience as to whether we would simply whitewash all of the Experience business as Martin & Co. But I think that would have negated some of the value that we were buying. Because at a local level, some of these brands are really good, strong, local and regional brands, well recognised by the public, and I think that what we should do is develop all 5 brands from this point on.
Oh, I like the idea that you're keeping both brands separate and useful. It's a little bit like the Greeks having stores on both sides of the street, but it's owned by the same family with entirely different names on them. Are you planning to expand in very specific markets? And approximately what do you figure each market will bring in revenue?
Okay, that's a good question. I think there are some specific markets, if you look at, because you can differentiate in a number of ways. At this stage, we don't see that we're going to differentiate in terms of a high-end brand, a low-end brand. That's not the decision that we want to take at the moment. But geographically, we believe there's a lot of value to be driven out, particularly the CJ Hole brand, and we're going to target specific locations across Gloucester, Bristol and Somerset, where if we haven't already got the CJ Hole brand in there, we're going to let the locals know we're coming to town, so you can either compete against us or you can join us. And if you look at the way that Remax Century 21 took estate agents in the US, that's exactly what they did. They said, you either join us or you compete against us. And we're gonna run that model in the next couple of years.
What do you see the advantages of having private investor shareholders? You've gone to the bank for where would you go next for money to fund other acquisitions?
Well, it's interesting. We've got other institutional investors who missed out on the IPO who've indicated to us that if we needed to do another fundraise, they'd be very happy to support us. And that's always good because, of course, that gives you large tranches of cash relatively easily. And there are 2 views, really. I think that because we are a property business, people like property. When people like property, it's tangible, there's an emotional connection to it. They might even see one of our offices and think, oh yeah, I know those guys, I've seen their board, seen the office. And it appeals to us to have retail investors. It's as simple as that. We like the idea of having retail investors. We also think that if we have a connection with the retail investor market, people who are retail investors are also probably landlords with properties. So we think there's a virtuous circle there, that you know, people will say, well, I bought the shares, and they're good guys, and I use them to rent out my property, and next time I'm going to buy a property, I'll turn to them first for some advice about it. So we would like to build, I mean, we're here tonight because we would like to build a retail investor base to our share. And I think for the long term as well, that might reduce share volatility, because I'm hoping that there'll be a degree more sort of free float ultimately, and regular transactions and a degree of predictability about the share price, which, when you're a new business on the market, is one of those potential pitfalls that your share price sort of ping-pongs around.
I had a question. Clearly, experience acquisition, as you showed on the graph, gave you that step change. Does there need to be a critical mass for the size of a firm if you were to acquire other organisations?
Because we're pursuing, because we are now pursuing a multi-brand strategy, it allows us to be more flexible, because we can come onto a target which may have just, say, 20 offices, and frankly, 20 offices to run that as a parallel brand with Martin & Co. wouldn't have made any sense. But now you've got 20 offices, and you think, well, actually, you know, that one I could put into that brand stable, that one I can put into that brand stable, that one I can put into the Martin & Co. brand stable. It allows you to pick through some of those acquisitions and simply put them into the various brand hoppers that you've got available to you. So that's an attraction.
And another question on franchisees. You mentioned in the cycle presentation that people from a whole range of different backgrounds. And now you are a public company. Do you have the same tolerance or open-mindedness with new franchisees, or you've got a more narrow, more professional, perhaps, or a different target for where do you get them from?
Yeah, okay. Well, we've never taken basket cases, so that's probably the first point, because frankly, as a franchisor, you don't make any money out of people until you're probably about 2-3 years in. You invest a huge amount in getting a new franchise out of the ground. So you've got to have this belief they're going to be good people from day one. I often got asked with the investor presentations, how many failures do you have? And I give the same answer, say 5%, they're lemmings. They're going to find a cliff edge, they're going to throw themselves off, there's not a damn thing you can do about it. Another 10% of people, they'll be disappointing. They'll say they're going to make a go at the franchise, and they never quite do it. But hey, 85% is a pretty good rate, and 85% of the franchisees that we've recruited historically have turned out to be good people and have built sustainable businesses, and that's a good hit rate. And we'll continue to fish in those ponds for that quality of franchisee. What I think has made me think my strategy is that the experienced people are typically career estate agents. That's their background. They came into franchising through a different set of circumstances, and it's making me think that there may be other estate agents out there that would like the idea of coming into a franchise group for the protection of that group, but are, dyed in the wool estate agents and have been all their lives.
Any other questions on the floor? I've got one final question then. Will you buy Hunters?
Will we buy Hunters? Hunters are intending to list themselves. They're often doing their IPO, so they have announced to the world today. So I think if they hadn't done that, we would have been interested in buying Hunters, but they're obviously deciding that going the IPO route would be good for people like Belmar, people like ourselves, and they're going to plunge in themselves. Wish them luck.
Thank you very much indeed.